Well, hello everybody. This is Jim Musgrave, and I want to welcome you to my Q1 2021 market review call. Well, the picture says it all. We've had a lot of thrills and spills over the last 12 months, and I'm going to get right to it and give you some great information in a way that you can apply this to your own portfolio and hopefully get on the right direction. So let's start here with the agenda. So we're going to give you a recap of the state of the economy and the recovery. We're going to go over some of the currents under the surface, what's moving the markets. And we're also going to give a case for the bulls, even despite the 2.5% pullback in the S&P today, and how to position your portfolio for today. And again, any investments mentioned in the market update are only to provide examples of various sectors and should not be taken as investment advice. All right. Well, I'm recording this on Wednesday, the 27th of January. And if you look at the top, the SP was down 2.5%. And if you look in the upper right, you can see that big red candlestick. So the market, as you see, since November has had a beautiful steady eddy run. And, the markets can only do that for so long and until they have to exhale. And that's exactly what has happened today. Again, we are still in a bull market, and we're not fully recovered from the market downturn of last year, but we've made a lot of progress. And so the main thing I want to make sure you guys realize is that when we have days like this, this is not the world coming in. This is not another bear market. We're in a period of higher volatility. As a matter of fact, statistically speaking, I mean, this is kind of crazy. Yes, if it seems like it's more volatile, it actually is. The number of single-day stock market returns plus or minus 2% or more in 2020 was 44. And it was interesting, if you look back in 2004, 680 days without a 2% trading day went on. So, we've had years where there was just very, very little volatility. But 2020 was a hugely volatile year, and again, we're going to see more of this volatility in the months and quarters to come. And just to show you that, I mean, you can look at last year. We had the SP was down -34, but it ended up roughly at +16. So again, even in a bull market, we can see these bear market pullbacks, and just you can see that the volatility that can happen intra-year. It's pretty astonishing. But if we look at our overall risk indicators, I love showing this. The ClearBridge Investments has a great report called Anatomy of a Recession. And you can see in December 31st, just about a month ago, we were actually an overall green positive arrow situation. I mean, again, the job sentiments was a little shaky, wage growth. We had some cautions and jobless claims and profit margins and trucking shipments. But overall, we are in a strong recovery. And so that's good. And just to give you some idea of kind of where we are versus, let's say, a 2007, 2008 recession, you can see that the economic indicators are completely different. In a true bear market recession, you're going to have a lot of X's and just a lot of carnage. That's certainly not the case right now. It's not perfect. We're not out of it, but we're still overall in a cyclical bull market. And you can just see how quickly the pullback recovered, and how, again, it was down -34 in about 4 weeks, and it actually came back to some sort of normalcy in a reasonably short period of time, especially compared to the dot-com bubble as well as the global financial crisis in 2008. And you can see in this chart, that gray line shows you that it typically takes roughly 9 months to drop where we were in just 4 weeks last year. So again, the bear market, the short bear market that happened last year was quite unprecedented, because we've never had that fast of a fall that quickly and recovery that quickly. And you can even see that the earnings history of the Q2 and Q3 were much stronger than the last recovery. And so again, we actually had some decent numbers in the second half of the year last year. And again, I kind of showed just the market volatility where we are. And again, we're going to have these pullbacks. Again, it's just part of the way that the stock market is, and they're uncomfortable. But we always recover. And again, if you look in the lower right part of the screen, you're going to see kind of what I showed you in earlier slides, that we are in a period of elevated volatility, and that's just kind of where we are at this point. And so, that's ultimately you have to. And I'm going to get into this in just a second, but ultimately, in order to get the kind of returns that you need, you're going to have to take on some risk, and we just happen to be in a higher than normal volatile period at this point. And again, the GDP, you can see things dropping off Q2 last year, and we're not fully recovered, but we're making progress. And you can see that 68% of the GDP is made up of consumption, and there are a number of sectors that are still being hurt pretty badly. That is kind of preventing that GDP to get back to the numbers pre-COVID. And you can see right here that the areas of leisure and hospitality obviously were hurt the most, and a lot of jobs are lost, but there have been some recovery. We're not fully there yet, but as the COVID gets under control a bit more, we should see these jobs coming back, and so will the markets and the economy. And you can just see some of the economic action that's happened over the last year or so. The purchase of mortgage applications, it dropped significantly, and then it bounced back. Same thing with consumer debt and transactions. What I really like about this is that in this period, people didn't spend as much money, and they actually paid off a lot of their debt, which is a really positive thing. On a negative area, obviously the hotel occupancies dropped significantly, but they've kind of rallied back. They're still down, but they've made a big comeback, as well as travel and navigation, number of people going to restaurants, and the number of people going through airports. Again, we're not back to normal. It's going to be some time before we are, but again, we have made some progress in going in the right direction. And everything is driven by COVID. You can see the charts right here that you look at the number of cases of people getting the virus, the number of fatalities. What's interesting, the ages 25 to 64, about 52% of the population are, that age group is getting probably half of the cases, but you can see that the number of fatalities are certainly square above the people above age 65. And just to kind of show you the most recent numbers, again, just kind of pull this from the New York Times. As of January the 26th, you can see that the curve is starting to drop a little bit. So that's really positive news. Obviously, we have a long way to go to get down where we need to be, but I think the numbers are going in the right direction. Thing I was concerned about was that we typically have a spike after the holidays. We certainly did after Thanksgiving, but it seems like people a little more cautious over the Christmas holidays. So that's a positive sign. So we have a ways to go, but at least we're going in the right direction. So let's look at the currents under the surface. So what's really been propping up the markets has been the Fed. And if you look at the lower left-hand corner there, you can see that the 10-year Treasury, at least at the time of the slide, was 80 basis points. It may be slightly higher right now, but if so, not much. And headline inflation is about 90 basis points. And the CBO baseline assumptions is that the yields as well as inflation is going to slowly pick up over the years. And so we're just in this period of very low interest rates and low inflation, but the inflation is slightly higher than the interest rates. So essentially what that means is that cash is good for liquidity. It's good if you want to kind of protect that part of your portfolio from drops in the market. But the big risk is purchasing power risk and inflation, which is huge, and people don't take that into consideration as much as they should sometimes. And you can see on the right side of the screen the federal net debt. You can just see that the deficits are projected just to continue to rise, which is going to be certainly problematic down the road. And you can see in the upper left, the federal government is just borrowing lots of money, And if you've attended any of my workshops, I kind of show you the U.S. debt clock. We're under $28 trillion right now, which is ridiculous. And so that path is not sustainable. And that's one thing that we've talked a lot about, is that just dealing with the deficit, just excluding politics aside, the chances are that that taxes will most likely go up at some point in the future. But that's really what one of the byproducts of the deficits. Now, what I want to talk about is the inverse relationship between interest rates and bond prices, because we talked about the interest rates very, very low but slightly rising. And I want to make sure you get this connection between low interest rates and your portfolio. Okay, so again, bonds have an inverse relationship to interest rates. When the cost of borrowing money rises, bond prices fall, and vice versa. And that's where we are right now. Again, the yields are low, but as the economy will start to pick up, we're also going to see the interest rates start to climb, which is going to put downward pressure on bonds. And again, will the Fed ever raise rates? Yeah, but not anytime soon. And you can just see that the forecast is to have the rates be very, very low for the extended future. And what's really frustrating, as I alluded to before, is that you look at the rates being low, then you add in the inflation, and so the real 10-year Treasury yield, which is the yield minus inflation, is actually in negative territory. So that's why it's really frustrating for retirees on a fixed income to make money in CDs and fixed securities. And this has been a real challenge in portfolio management, especially the bond portion of the portfolio. One thing that we've all noticed is that the inflation in certain areas is higher than others. I've noticed this in my own food bill, not just because me and my wife are eating more at home, but also just the cost of food is going up. So if you look at November of last year, food CPI is about 3.7%. It's a whole lot higher than what CDs in the 10-year Treasury is yielding right now. So that's a real problem in terms of the inflation that we're all experiencing right now. So the question is where should you be in your bond portfolio? Well, one of the things is that, so what's the purpose of the bond portfolio? Typically, a bond portfolio has two purposes. One purpose is to minimize losses when stocks drop, and the second purpose is to provide some sort of yield. Well, when the yield is as low as it is, then you revert back to bonds being a part of the portfolio that will minimize losses when stocks go down. And so the areas that you want to be in your fixed income portfolio are the areas that are not as correlated to the S&P 500 or the stock market. So I have a couple or a few sectors circled right here. One is TIPS, or Treasury Inflation Protected Securities. Those are short-term securities that tend to reset and do fairly well when the markets go up. And so having a portion of the portfolio in TIPS is certainly a smart thing to do in this current environment. Also, just investment grade corporates and the U.S. aggregate, and we're going to show that chart in just a second, are certainly areas that have low correlation. But the other thing too is that sometimes you can use that to your advantage. So if you are a tactical manager like we are, we look at trends. And if you look to the right, you'll see convertible bonds tend to have they tend to be a little bit more correlated to stocks, and also they tend to do well in a period of rising interest rates. So that's something to kind of take into consideration. If you want to take a little bit more risk in the fixed income, you can dabble in the convertible space if you like. And just to kind of show you, here's the AGG, the Aggregate Bond Index. You can see that the big zigzag on the left, that was the COVID meltdown. Again, not only stocks, but bonds dropped back in March. The Fed inserted liquidity, and the bonds rallied fairly well. And you can see that it happened until early August, and then rates started to go up a little bit as things started to recover. And then the trend has kind of reversed in a downward slope. And so that's the overall bond market. Now, we find that that's going to be the case with many other sectors, with treasuries or corporates or high yield. They're all kind of pointing in that That's south direction a little bit. It's not falling out of the basement like it did in March, but you can see that slow decline. So again, that's the challenge of the fixed income. As interest rates go up and the bond prices go down, and so it really pays to be tactical and watch that fixed income portfolio very carefully. And again, I have a lot of federal clients, and I always like to kind of show the TSP. And you can see the G fund, which is the stable balanced fund, did just shy of 1% last year, and the F fund, which is the AGG that I just showed you on the previous screen, did about 7.5%. And so the problem with having a huge portion of the portfolio in the G fund is that you're not keeping up with inflation. And I've met with a lot of people over the last year that got scared when the markets dropped, moved a lot of their money, if not all the money, in the G fund, and never got back. And in retrospect, that was a real mistake. So again, the big issue with the G fund is that it's okay to minimize losses, but you're also giving up purchasing power. And this is a perfect example of why you need to be diversified, even in your fixed income portfolio. So the F fund returned roughly 7.5% in 2020, and it dropped roughly 10% in March before it recovered. So if you had allocated a portion to the G and the F funds, you would have both reduced your volatility and had a better performance. And that's kind of the whole concept of diversification in the first place. And it's no surprise that the sectors on this slide on the far left did the best and the far right didn't do so well. So obviously online retail, technology were the top sectors. And on the far right, the worst performing sectors obviously were energy, airlines, retail REITs, hotels, resorts, cruise lines. Anything like those sectors primarily just did horribly. And it's completely understandable why. As we get more people vaccinated and things start to come around, we're going to see those numbers kind of rally. And we've already actually seen a rally in energy sectors, notably clean energy as well. So again, this is a snapshot of December. It's a snapshot of December 31st, 2020. But as you know, sector rotation constantly happens. So this is a perfect example of that. So small cap stocks were the best performing, followed by emerging markets and large cap. And the worst performing sector last year were REITs, real estate investment trust. But what I want you to look at is the previous year in 2019. REITs were the second best performing asset class at 28.7%. Okay, so depending if you're a buy and hold kind of modern portfolio theory type of investor, having a portion, a well-diversified portfolio, you just have to understand that certain asset classes that you own are going to do well in some years and not do well in others. Okay, you just have to accept it because that's by definition what you're doing. We tend to be a little more tactical, and we tend to overweight areas that are really making money and underweight ones that don't. But again, we're just kind of pointing out the sector rotation of the different asset classes that you and I can buy right now. So again, the case for the bulls. Again, we feel that we're actually in a new secular bull market. Again, the past 12 months following an all-time high, the stocks have historically been up 8.6% on average with a positive return of 71% of the time. Those are pretty good odds. And when you actually look at the vaccine rolling out, incredible Federal Reserve stimulus, and also there's just a lot of pent-up demand. And also, if you just look at historical statistics like this, actually 2021 is actually shaping up to be a pretty good year. And again, the odds are in our favor in terms of just looking at historical expansions and how long things last. Again, can the year end of 2020 strength continue? The answer is yes. So if you look at that, the S&P 500 price return after 3 months has averaged 6.8%. That's been positive 100% of the time. Over 6 months, 12.5%. Over 12 months, 18.1%. So again, following a 10% plus rallies in November, December, stocks have typically continued to deliver strong gains in the subsequent years. Okay, So again, when the S&P drops 2.5% like it did today, okay, that is an exhale. Now, the market may continue to drop a little bit. Maybe the market will drop 5 or 10%. That is okay. That is normal. Okay. And again, speaking of normal, we actually feel that 2021 may be one of the better years in the last 20 years. Okay. So, and again, a lot has to do with the vaccines and people kind of getting back to normal. And we've seen quantitative easing not only in the United States, but also the Eurozone and Japan. So we're going to see very easy monetary policy across the globe for an extended period of time. And obviously we feel that stocks are very attractive compared to bonds. And again, we tend to be a little bit more equity focused in our portfolios, or we're able to take on a little more risk in the fixed income because we just feel there's more opportunities in stocks and bonds at this point. And another challenge is where are you going to get your dividends? As I said before, that the bond portfolio typically has two functions. One is to minimize losses when the stocks go down, but two, provide yield. Well, when you've got yields so low in your bonds, the only way to get yields is to take on more risk and have exposure to high yield or convertibles. And what we found is that, again, 49% of the S&P 500 stocks now have dividend yields that are greater than a 30-year treasury. So we've been getting more of our yields from our equity portfolio versus our bond portfolio. So that's one of the things that we look at and purposely put into our portfolios is to make sure that we have good, strong dividends. And what's interesting is that over the years that U.S. stocks have outperformed international. But if you look at the very, very end of the chart on the right, you can see a little downturn. And what you see is that that international has actually started to outperform U.S. in just in the last 12 to 6 months or so. And you can kind of see that a lot of that's kind of driven by the dollar. So as the dollar weakens, international markets, especially emerging markets, tend to do better. And you can see in this slide right here, that's exactly what I'm talking about. So again, weaker dollar supercharges non-U.S. stocks. So you can see, historically speaking, when the dollar goes down, emerging markets tend to do very, very well as just international stocks in general. So again, this is another argument for diversification. Make sure you have exposure to international equities. Again, we like emerging markets as well. Of course, we can't talk about emerging markets without China. And again, they've certainly become a larger and larger player in the global growth over the years. And so again, China got a hold of the COVID-19 virus faster than the United States has actually had a positive GDP last year. So again, having exposure to China in your market is certainly a good thing to have. So where should your portfolio be allocated at this point? Well, again, we have to kind of look at historically speaking, we're in a period of low interest rates and rising inflation. And if you look at the lower left right here, you can see that this is just a case for diversification. Obviously, cash is not doing as well, but historically speaking, equities, both growth and value, small cap, emerging markets, real estate, commodities, gold, have all done pretty well over again 4 times since 1998. So again, this is you can still have a tactical tilt, but you should still be diversified, and this is certainly an argument for doing so. So how do you position your portfolio today? And again, think strategically. Okay, so where we feel is that people should be diversified. As you can see, we kind of showed you all the different asset classes and the sector rotation. That is a constant. But the areas that we feel that will do well moving forward are technology, consumer discretion, healthcare, clean energy, emerging markets in Asia, investment grade corporates, short duration corporates, tips, high yield. And I talked about this in my last market review call at Q4 last year. ESG, environmental social governance. Again, that is a really important component of portfolios from now, and it's going to continue to be even more important as time goes on. And just to show you a little bit more about the ESG, again, if you're not familiar with this, this is it's basically sustainable investing. And you can see just across the globe in the third quarter of last year, over $80.5 billion of money flew into ESG mutual funds and ETFs. Most of it is in Europe. So Europe's a little ahead of the United States on this movement. But this is, and again, if you're familiar with Larry Fink, the CEO of BlackRock, he just released his letter to corporations today, and we will be doing more webinars and more educational things on ESG investing. But this is something that you guys need to be aware of, and kind of think. Basically, what it is, it's a way of filtering out certain stocks that don't meet a certain criteria. And in the past, people invested in ESG because it was in alignment with their values. Now we're seeing that you can invest in ESG to be in alignment with your values, but also because of performance. And we've actually found that ESG ETFs, not 100% of the time, but certainly more than often, are actually outperforming the normal, cap-weighted ETFs and mutual funds. So we can certainly talk about that if you like on a one-on-one basis. So where we are, so it's time to review your portfolio and determine whether you should change direction. Okay, we can help. So if you're listening to this call, you're either a client of mine or you're not a client of mine, or you're a client of mine that I'm managing a portion of the money and maybe not other monies. So it's in your best interest to actually do a portfolio review, see how your accounts are doing, and compare them. And it's there's so much change going on. It's really good to see what you have and compare what you have against other ideas. Maybe you're taking on too much risk. Maybe you're not taking on enough risk. But ultimately, we can help you do that. We can actually run reports, and there's actually a report called the 360 Evaluator that I can share with you that really goes in depth about these things. So again, you got a choice. You can stay the course and don't make any allocation changes just because you're too busy or it's not a big deal to you. Or you could be nimble and strategic and make adjustments in your portfolio. Again, you can be nimble and make these changes and make sure that you are in the areas that are doing well and you're projected for growth. So again, I want to conclude here. Again, if you'd like to schedule a 30-minute call, we can kind of review your portfolio. I can answer any questions for you. Just give me a call. There's my email, and we can go from there. So again, I also love to have your feedback. Let me know if this is good, if there's anything you'd like me to cover, if you have any specific questions. But this is my contact information. I look forward to hearing from you. And if I don't hear from you, I'll be lookout for the Q2 market video that'll come out sometime in April. So in the meantime, have a good day, and we'll talk to you later. Take care.